Which investment provides the best rate of return on a moderately risk-free investment? We'll attempt to answer that question in our comparison of an investment in the stock market to an investment of an equal amount into a residential real estate investment. If properly executed, nothing provides more bang for the buck than residential real estate investment. Investment in residential real estate is one of the best ways to increase the yields on invested assets, and it's less volatile than investment in the stock market. Despite the higher return on investment, real estate investment involves more participation than the more passive investment in stocks or bonds. The time and attention required to maintain a real estate investment may not be right for everyone. Real estate investment is ideal for anyone who is now retired or who, after leaving the workforce for any reason, has more time and resources to devote to managing a real estate investment. It's also suited to families with a stay-at-home spouse that has sufficient free time to devote to the handful of hours per month it takes to manage a rental property. And in the modern-day workforce, an increasing number of workers are not tied to the office or to a time clock, and accordingly have the nominal amount of time required to manage a residential rental property. It should be noted that the minimum amount of cash to purchase the type of real estate we're using in our comparison is probably at least $50,000, even in markets with low entry points, such as Texas. Whereas investment in the stock market has no real minimum limit, although some high-priced stocks may be priced out of the range of some investors, even when purchasing a single share. We wanted to do a comparison that would benefit the greatest number of potential investors. To that end, for our stock participant in this comparison, we opted for the Vanguard S&P 500 ETF. This is an exchange-traded fund that isn't subject to some of the drawbacks of a mutual fund and can be purchased on margin. In a separate analysis, we determined that leverage purchase of an ETF resulted in a slightly higher rate of return when compared to a non-leveraged purchase, so we're showing a leveraged stock investment in this comparison. This Vanguard ETF also has the lowest expense ratios of all ETFs tied to the S&P 500. The maximum amount that can be borrowed to purchase an exchange-traded fund is 50% of the price of the shares. So with a cash outlay of $125,000, our margin loan to purchase the stock would be $125,000 and the total value of the purchased stock would be $250,000. To compute the dividend returns and value appreciation in our comparison, we use the 10-year average for the S&P 500 index at 11.68%. We apportion this total return based on our research to 1.2% for dividends and 10.48% for appreciation in value. The margin rate at most brokers for this size of investment would be in a range from 10.75% to 11.25%. We use 10.75% for our comparison. After combining the dividend income and appreciation in value and subtracting the interest paid on the margin loan, the resulting return on investment for the year was $15,763, creating an annual rate of return of 12.61% on the stock transaction. For the real estate transaction, we used $125,000 in cash for a down payment and used a mortgage loan for $375,000 to finance the remainder of the $500,000 purchase price of a 4-unit residential property. We had done several loans on this type property in Texas and were familiar with the value, rents, and expenses on a property in this price range. We also had access to appraisal reports on these properties to substantiate our income and expense estimates. For real estate appreciation, we used $23,100, representing a 4.62% annual appreciation rate, which was the 10-year average annual appreciation in home sale prices in Texas. Annual rent receipts were estimated at $60,000, representing 12% of the value of the property. We estimated operating expenses, including property taxes and insurance, at $21,000 annually, representing 35% of projected rental receipts. The interest included in the comparison was $28,594, based on an interest rate of 7.625% per annum. This was the published rate for applicants with excellent credit on our investor DSCR program, on transactions with a 75% loan-to-value ratio and with no origination fee and zero discount points. After combining the rental receipts and value appreciation for the year, then subtracting the rental operating expenses and interest paid on the mortgage during the year, the total return for the year was $33,506, which produced a rate of return on our $125,000 cash investment of 26.8%. The following chart shows the comparison of this data on the two transactions with the resulting returns and rates of return on each. As you can see, on the passive stock investment, the appreciation in value was higher on the stock purchase, but the income derived from dividends on the Vanguard ETF was woefully low compared to the real estate transaction. Because we were able to leverage more in the real estate transaction, and because the rate of interest on the leverage portion of the transaction was so much lower than the rate of interest on the stock margin account, our return was significantly higher on the real estate transaction. With a rate of return of 26.8%, it was more than double the rate of return on the Vanguard ETF investment. The estimates for operating expenses in the prior comparison were based on a self-managed real estate property. When a property management fee of $6,000 was added to the amount of operating expenses, the rate of return on the real estate investment was reduced to 22%. This rate still exceeded the rate of return on the investment in stocks by 74.46%. Our analysis has not taken into account the tax consequences of these investments. The tax consequences vary depending on the tax status and characteristics of the investor and on the state in which the property securing the real estate investment is located. That analysis is beyond the scope of this comparison. Although the after-tax return on investment would be affected by tax consequences, the general principles related to the pros and cons of these types of investments are the driving factors in choosing the type of investment best suited for each investor. The tax consequences would only be collateral consideration. We will devote a video in the near future to the topic of tax consequences for these forms of investment. Check the video description section for information on related videos. Factors other than achieving the highest rate of return may impact your choice of investment. Residential real estate investment requires some level of active participation that is not required for a venture into the stock market. But due to the magic of leverage, a real estate investment will yield higher rates of return than a stock market investment. A real estate investor can finance up to 85% of the value of purchased residential real estate. An investor in stocks of the type we used in this comparison is limited to financing 50% of the value of purchased stock. And the interest rate on the real estate mortgage is typically 3 to 4 percentage points lower than a loan used to finance the purchase of stocks or exchange-traded funds. These two factors combine to enable the real estate investor to more than double the rate of return on his investment when compared to investment in stocks or exchange-traded funds. For investors that have the time and resources required for the higher level of participation required for residential real estate investment, this form of investment is the best way to achieve higher returns on existing assets. Our company now offers investor financing in 19 states and will soon be expanding to even more markets. Contact one of our investor loan consultants to explore strategies customized to your particular requirements and objectives.